It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at companies with roots from outside of the U.S. I'm here with Thornburg Investment Management Portfolio Manager Emily Leveille. Thank you so much for being here. Appreciate it.
Thanks for having me. Nice to be here.
So I have to admit, I don't know if this is a goodbye or goodbye first. I had not heard of the company that is your goodbye, but let's get to it. It's Globant. This company up about 6% over the past 12 months. I believe it's domiciled in Uruguay, but it also has headquarters in Argentina. So I was not terribly familiar, but does do IT consulting here. And you say one of the reasons you like it, it's a beneficiary of AI. Walk us through that.
Sure, absolutely. Well, maybe a better place to start is those of you with kids. Disney Plus is probably a big part of your household. One of the companies helping to bring you the magic is actually Globant. Disney is one of their largest clients. They've been working with them throughout their digital transformation for many years. We like Globant because we think Globant and IT services businesses in general are a key enabler of AI transformation at an enterprise level. We also think that the stock price has suffered over the last couple of years as there's been a lot of debate around whether or not IT services companies would benefit from AI. Globant has been using AI. They've been at the leading edge of this for many, many years. We think they're going to help companies transform. We think this is a business that can grow 15 to 20% EPS for many, many years to come. This is a big TAM. These guys are only doing $2 billion in revenue. This is a $300 billion plus global market. So they can just gain share, execute. And again, they're trading at valuations that are really reasonable now. So for a 20% time earning business, you're looking at a mid-20s price earnings multiple. So really reasonable for the growth.
And let's talk about the industry more broadly here, because you point out they're growing faster than their peers. Who should we think of as their peers and then their growth relative?
Yeah, it's a really fragmented market. You can think of Accenture as probably the best known sort of large peer, but there's also a lot of other smaller names out there that are focused on different parts of the industry. Infosys in India, Tata Consultancy, EPAM, and Dava. These are all sort of very niche parts of the business. Globant in particular is really strong in consumer entertainment, in that sort of front-end digital transformation, helping to bring the customer along a digital journey. They've been really transformative in the parks of Disney as well. So that's really where they shine, is really in that front-end digital transformation.
And sort of come back to that point you were making, they're growing faster than peers, you say, but their its valuation is lower than that of peers.
Yeah, they traded a little bit of a premium to Accenture, but relative to its history, valuation is compressed by almost 50% from what we saw in sort of 2021, 2020 peak. And we don't really see any change in the earnings power or the duration of earnings for the business. We think, again, they're going to continue to be real enablers, helping enterprises transform their businesses, transform their data, utilize AI in order to save costs and generate a better experience for consumers.
Well, as always, when we do this, we like to point out what could go wrong or what are some of the risks here. And so it's just, obviously there are a lot of growth concerns that are cropping up right now.
Absolutely.
So how much do you sort of take that into account?
That's one of the things we really like about where Globant is right now. We think the downside is pretty de-risked, given you're also starting to see a recovery in spend in cloud services in the non-AI part of the business. So you had big digital transformation during COVID. They were a big beneficiary. Then you had a little bit of a hangover where spend in digital transformation slowed. Now you're starting to see signs of a recovery. Accenture increased their guidance. They talked about AI. They talked about stabilization in non-AI spend. We're seeing the same thing for Globant. So we think the risks are pretty well balanced, or we think the risks are less than the reward at this point. We think valuations really de-risk some of the downside scenarios. But you could see, if you got a really big macro slowdown, if you had companies really pulling back on spend. But AI is really strategic. People are really thinking about how do we transform our businesses for the next 3, 5, 10 years.
How do I save some money for that particular? So let's get to the stock you don't like as much. This one is LVMH, and this stock's already down more than 20% over the last year if you look at the French shares. And here, even if we're seeing an economic slowdown, it's probably going to be PC, if you will. And already LVMH has sort of talked about the consumer being weak in some areas.
They have. So, you probably know LVMH from the eponymous Louis Vuitton or LV handbags. Speedy bags are, everywhere in New York. Everyone's using them at the beach. They're bringing them in their laptops to work. We really love LVMH over the long run. They're an incredibly managed luxury business, but we think LVMH was a big beneficiary during COVID. They took a lot of price. And now we're starting to see signs, especially in the United States, but also in China. The consumer has been weak for a while. About a third of their business is exposed to China. And most recent earnings confirmed an incremental slowdown of growth in the organic part of the business, particularly in the fashion and leather goods part of the business, which is the highest margin part of the business.
Right.
So we think that there's probably a couple more quarters at least of slowdown in their business on an organic basis.
Right.
And therefore we wouldn't be buyers right now. We would wait.
Gotcha. And let's get to the valuation as well and the estimates for what people are expecting out of LVMH. You think they won't be able to match them?
Exactly. So I think expectations for the back half of the year probably need to come down. They did very low single-digit organic growth. The market expects them to accelerate to a higher single-digit growth based on the trends we're seeing in the market, based on some of the consumer data we're hearing from companies across the spectrum in the United States, and also what we're seeing in China. We just think that there's a higher likelihood that estimates need to come down.
Gotcha.
Eventually we think they'll rebound, but we think that estimates are still too high.
And then finally, they raised their prices a lot during COVID, benefiting from demand. But you say that means the entry-level consumer there's no accessible luxury, I guess.
Exactly. So, in China, they actually saw their consumer base shrink for the first time. And, I think you've seen a similar dynamic here where maybe somebody graduated from college, they got a new job, they got a great bonus, they went to buy a handbag, but Louis Vuitton raised prices and the whole luxury industry raised prices pretty significantly. So I think that they need to provide a consumer with the consumer needs to adjust. That entry-level price might be a little bit too high now for your new buyer, and that's really how you cultivate that customer journey, that buyer over a long period of time. So I think they're going to have to adjust. I think they're going to have to come out with some new and innovative products and really sort of excite the the new buyer, the aspirational buyer. And the market is a little weak right now. Maybe people are thinking, maybe I'm not going to buy that extra handbag at Christmas or when I get my bonus. Maybe I'm going to save it because I'm not sure what's going to happen with the elections, with the economy.
And then if something was going to go right here, it would be that China would recover.
Absolutely, yeah. So I think, China recovering, maybe the U.S. consumer rebounding, being a little bit stronger than we expect. But I think probably in the near term, your biggest incremental change is going to be you really start to see a recovery in the Chinese consumer that's been weak. We've had a number of false starts since 2021. And at some point, we do believe the Chinese consumer will recover, but we just don't have visibility on when that's going to happen. When you start to see that happening, LVMH, I think, is going to do really well. They're going to regain that traction in the economy there.
Gotcha. All right, Emily, thank you so much for coming in.
Thanks for having me.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.